Okay, so this is the income tax accounting part 2, and we will have practice exercises here to illustrate how to solve the problems in income taxes for accounting, and basically know how to journalize deferred tax assets and deferred tax liabilities. Alright, so we have 3 illustrations here for practice exercise 1. So our requirement is to determine tax base, temporary difference, and deferred tax. Okay, let's go through it. Company A has a depreciable non-current asset. The cost is 500,000 kina and has a carrying amount of 300,000 kina. For tax purposes, accumulated depreciation amounts to 250,000 kina. The second situation, the company recognizes a liability of 600,000 kina for accrued warranty cost. As is the case for many accrued expenses, the tax office does not treat the expense or the expenses as deductible until the entity actually meets the claim. Third situation, the company has accrued or accounts payable or accounts receivable of 450,000 kina and an associated doubtful debts allowance for 90,000 kina. The revenue associated with the accounts receivable of 450,000 kina has already included in taxable income, while the doubtful debt will be deductible when the amount are actually written off as bad debts or bad, with related deduction to accounts receivable. Alright, so the first thing, we have already noted some of the carrying amounts mentioned here. So that's the first thing that you have to do, and determine the tax base. Only when you have determined tax base and carrying amount, you will be able to know the temporary difference, and you will be able to determine the deferred tax. So let's see the solution on the next slide. Okay, so we have a depreciable asset carrying amount of 300,000 kina. Future deductible amount is 300,000 kina. So which means as per accounting, you will be able to deduct this in your income statement in the form of depreciation. Okay, of course in the future. Then add future taxable economic benefit. This 250,000, because it is the recognized tax base or recognized amount as per taxation, this will be a future economic benefit for your taxable income, because that will be reduced, or it will reduce your taxable income. Take note, 300,000 is the amount recognized per accounting standards, while tax base is the amount recognized by IRC. Now, if you recall the guide that I have given you, if carrying amount is greater than tax base for an asset, that will result to taxable temporary difference. The opposite will happen if the tax base is greater than carrying amount. So in that case, that will result to deductible temporary difference. Okay, so in this case, we have taxable temporary difference of 50,000 kina. So if you multiply it by 30%, that will result to 15,000 kina. And this will be deferred tax liability. Again, you can refer to the note that I have given you in the previous presentation. The second one is a liability account. So the carrying amount, or the amount recognized as per taxation, rather accounting, okay, will be 600,000 kina. Now, because this one will not be able to be deducted, okay, or already been deducted as per accounting, but will not be able to be deducted per taxation, not unless it is already been written off. In the eye of the tax authority, accrued warranty cost is non-existing. So which means the tax base will be 0. Okay, so when you refer to the journal entry to recognize accrued warranty cost, that will be debit warranty expense and then credit warranty or accrued warranty cost, 600,000. But per taxation, you are not supposed to recognize expense, or you cannot claim it as a deduction, not unless it is actually been paid by the company. So which means in the eye of the tax authority, that accrued warranty cost is non-existing. So you can see here, tax base will be 0. Or you can use the calculation presented here. Carrying amount, add future deductible amount, less future taxable economic benefit, then that will be, the result will be tax base. Now here, carrying amount is greater than tax base. This is a liability. So if you refer to the first situation on top, the opposite will happen. So here, the difference will result to deductible temporary difference. Okay, so 600,000 less, of course, 0, that will be 600,000 kina. Then you multiply it by 30%, that will be 180,000, and that will result to deferred tax asset. Okay, accounts receivable. We have a carrying amount of 360,000. Okay, so you determine that by deducting the gross amount of 450,000 kina less 90,000 kina. And then there is no future taxable economic benefit here because you already recognize the total amount of revenue pertaining to accounts receivable for your current income statement. So that will be 0. Now, tax base here is 450,000 kina. In the eye of the tax authority, allowance for doubtful debts can only be recognized as a deduction if there is an actual write-off. In this case, if you are setting up allowance, it's not an actual write-off. It is an expectation, as per accounting rule, that this amount will not be able to be collected. So when we determine here, carrying amount is less than tax base, so that will result to deductible temporary difference. So here we have 90,000 kina. So 90,000 kina multiplied by 30%, that will be 27,000 kina. And that is a result, or the result will be deferred tax asset. Okay, so practice exercise 2. This is all about revaluation. Okay, so ABC Limited has a parcel of land which they purchased back 1st January 2017 for 2 million kina. As of 31st December 2019, so meaning 2 years had been expired, the revalued amount goes up to 3 million kina. So our requirement, journalize the recognition of the revaluation surplus with the tax effect. Okay, so the first thing that we have to do is to get or determine the difference between the carrying amount against the revalued amount. So the revaluation increment here or increase is 1 million kina. Difference between 3 million against 2 million kina. So that's the first entry. The second entry, please take note of this. Should be done, or this should be done at the end of the accounting period. Okay, so which means the revaluation may happen at any time within the year. Okay, but the closing up gain on revaluation for revaluation surplus should be done at the end of accounting period. So that entry will be debit gain on revaluation and then credit revaluation surplus. Then afterwards, you have to determine the tax effect. So the tax effect here, that will be 30% of 1 million kina here. So debit income tax expense and then credit deferred tax liability. Alright, so the last practice exercise here, we have unused tax loss. Okay, so the problem goes, Garamut Limited started their operation in 2016, in which they incurred 2 million kina. IRC allowed for the carry forward loss for 20 years. So which means out of 2 million kina, there is a tax loss of 30% of that 2 million kina, that will be 600,000 kina. Profits for the succeeding years are as follows. So we have in 2017, 600,000 kina. 2018, we have 800,000 kina. And 2019, we have 1.2 million kina. So we have a tax rate of 30%. The requirement, provide the journal entries to show the recognition of the asset associated with the tax loss, as well as the journal entries to recognize the use of the loss. So we will calculate the income tax expense here in 2017, 18, and 19. Okay, so the tax rate is 30%. Now the tax loss in 2016, we will carry forward for the years, of course, up to 20 years. Right? So if the tax loss has already been consumed, then there will be income tax expense. Okay, in 2016, we have debit deferred tax asset and then credit income tax revenue. So this one will be carried forward for 20 years. Of course, they will try to offset it in the income tax recognized for the succeeding year. So 2 million kina times 30%, we have 600,000 kina here. Now in 2017, we have 600,000 kina multiplied by 30%, that will be 180,000 kina. So debit income tax expense. And now instead of income tax payable here, they credited deferred tax asset, 180,000 kina. Okay, in 2018, we have 800,000 kina as profit. If you multiply it by 30%, that will be 240,000 recognized for income tax expense. Now, again, we will credit deferred tax asset, but before you do that, determine first if there is an existing or remaining amount for deferred tax asset. So, for the last year, we have 180,000 kina that we deducted from deferred tax asset in 2017, which is 600,000 kina. So meaning we still have the remaining amount of 420,000 kina in 2018. The 240,000 is still okay. For 2019, 420,000 less 240,000, the amount of credited deferred tax will be 180,000 kina here. Okay, in 2019, we have 1.2 million kina as profit. So if you multiply by 30%, That will be 360,000. So debit income tax expense. Now the remaining deferred tax asset of 180,000, that will be credited here. And now any excess between income tax expense against deferred tax asset, that will be charged to income tax payable. And that ends my presentation for income tax accounting practice exercises. Thank you.